Hello, everybody. Welcome to Clef Investments. Let's continue to talk about how to plan for future generations. Last time we covered kids' Roth IRA, and this time let's talk about kids' investment account, how to use this account to reduce your own capital gain tax. Okay, so if your child sells some stocks or something else and get up to $2,600 of capital gain in 2024, this amount of capital gain only need to pay very few tax. Assume your child doesn't have any other income. And for this number, $2,600, it changes, and you should search kiddietax to find the up-to-date amount. In later years, it often increases, adjusted maybe by inflation. So this means you can give your child some stock which has lots of capital gain, which has a very low cost basis. You don't need to sell it. You give the stock to your child and your child can sell it. As long as the capital gain in each year is less than this kiddie tax limit, you're okay. For any capital gain that's more than this amount, then the kid will pay parents' capital gain tax, which could be very high. So how do we use this limit, and how do we give kid something for them to sell? Basically, parents, mom and dad, can gift each child $36,000 a year, up to this amount. This is the free gift tax exempt amount. And this amount is double the regular 18,000 because parents, there are two parents. And for every kid, you can do that. So you can transfer some stock to your child as long as the total amount is less than this much. It's completely gift tax free. If you transfer more than this amount, then it will be deducted from your lifetime gift tax exemption, which is connected to your estate tax. So in most cases, you want to use a free amount of $36,000 and do not give more than that every year. And this amount also increases adjusted for inflation. So please search online to find out the gift tax limit for your given year. And remember, you can transfer your stocks. You don't need to transfer cash, because with stocks, if it already has lots of capital gain, you're transferring, then the capital gain now belongs to your child. And they can sell the stock and pay a very low tax using this kiddie tax rule, and you don't need to pay. If you give them cash, you have to sell it, pay the capital gain tax, and then give them cash, which will waste lots of money in the tax. And if you have RSU stock from your work, then when you transfer, you need to keep track of the cost basis yourself, because RSU stocks are uncovered stocks, and your brokerage doesn't know the cost basis. So you need to download and keep track of all the proper statement vesting information, so that later when your child sells them, you can fill in the correct cost basis. And of course, make sure the total capital gain plus dividend must be less than the kiddie tax limit. So you may think that, well, only $2,600 a year. Is this a big deal? Okay, so let's do some calculation. If you give your child $3,000 worth of stock every year, and you can start doing this when they are just born, and you give this until they are graduated from college, which is 22 years. So in the end, how much money will they get? And assume you give the money to them, they sell it with very low tax, almost zero, and then they buy and hold stock index. So at age 60, this amount of money will turn into 2.4 million. They become a millionaire. And 80, it's almost 10 million. And at 100, if they are not spending this amount, it's 39 million. So you can see the calculation in this form. Let's take a look. Okay, you go to the kids gift capital gain. And this is the annual gain. And this is the amount you're investing. So every year you invest $3,000. Assume the stock has $400 of cost basis. So you sell it, every year it grew based on this annual return, which we assume the stock index would double every 10 years. It's kind of conservative. And we keep going. And at age 22, then the last time they get this money. And it keeps growing. So when they turn into 60, it's almost 2.5 million. And age of 80, almost 10 million. And so on. Okay, so if you give this amount of money to your child and they need to file a separate tax, basically the child's tax, it should select someone can claim you as a dependent. And then you can still claim your child as dependent, and your child just need to pay the tax for the capital gains. And if in some year your child earned more than half of their spending, for example, they have some good intern in the summer and they make enough money, then they can file tax on their own. And you can sell more on that year. Try to keep their income lower than 40K, because at that time, the capital gain tax is very low. Okay, one last thing you need to remember is that the dividend is also count toward the kiddie tax. So that means when you buy and hold stock index, please consider an index with lower dividend. So if you compare S&P 500 and Nasdaq 100, Nasdaq 100 has a lower dividend. Therefore, it's more preferred. So you could buy QQM instead of VOO. Okay, that's all for today. Thank you.